Did you know that the average homeowner saves thousands of dollars each year thanks to the mortgage interest tax deduction? That's right, thousands. This valuable tax break can put serious money back in your pocket. It's like getting a bonus just for owning a home. The mortgage interest tax deduction allows you to reduce your taxable income by deducting the interest paid on your mortgage. This means you pay less in taxes overall. It's a powerful tool for homeowners, especially in the early years of their mortgage when interest payments are typically higher. Don't miss out on this incredible opportunity to save. Understanding how the mortgage interest tax deduction works is crucial for maximizing your financial well-being as a homeowner. Let's dive deeper and explore why this deduction is so important. Tax season can be a stressful time, filled with forms, deadlines, and the dreaded thought of owing money. The pressure to get everything right can be overwhelming, especially when you're unsure about the deductions you qualify for. But for homeowners, the mortgage interest tax deduction can provide some much-needed relief. This deduction is a significant benefit that can make a real difference in your financial situation. By reducing your taxable income, this deduction lowers your overall tax liability. Essentially, it decreases the amount of income that is subject to tax, which can lead to substantial savings. This means you could end up owing less in taxes or even receiving a larger refund. Imagine the relief of getting a check in the mail instead of a bill. Imagine the possibilities with those extra funds. You could use the money to improve your financial health or invest in opportunities that could grow your wealth. You could pay down debt, invest in your future, or save for important life goals. Or finally take that dream vacation you've been planning for years. The extra funds can help make your dreams a reality. The mortgage interest tax deduction is especially beneficial for those in higher tax brackets. The higher your tax bracket, the more valuable the deduction becomes. This is because the deduction reduces your income in the highest tax bracket you qualify for, leading to greater savings. It's a smart strategy to maximize your tax benefits. However, even those in lower tax brackets can benefit from this deduction. Every bit of savings helps, no matter your income level. Don't let this valuable tax break pass you by. It's an opportunity to improve your financial situation with minimal effort. In the next section, we'll address common misconceptions and ensure you have the correct information to take full advantage of this opportunity. Stay tuned to learn more about how you can make the most of the mortgage interest tax deduction. There's a lot of misinformation floating around about the mortgage interest tax deduction. Let's clear up some of the confusion and separate fact from fiction. One common misconception is that only wealthy homeowners benefit from this deduction. This is simply not true. While those in higher tax brackets may see larger dollar savings, the deduction is available to any homeowner who itemizes their deductions and meets the eligibility criteria. Another myth is that you can only deduct interest on your primary residence. Actually, you can also deduct interest on a second home, such as a vacation home, as long as it meets specific requirements. Don't let these myths prevent you from claiming a deduction you deserve. By understanding the true eligibility criteria, you can confidently navigate the tax system and maximize your savings. Now that we've dispelled some common myths, let's dive deeper into the specific criteria you must meet to qualify for the mortgage interest tax deduction. This deduction can significantly reduce your taxable income, but only if you meet certain requirements. First and foremost, you must itemize your deductions on your tax return. This is a crucial step because if you opt for the standard deduction, you won't be able to claim the mortgage interest deduction. This means you'll use Schedule A of Form 1040 instead of taking the standard deduction. Schedule A allows you to list all your itemized deductions, including mortgage interest, medical expenses, and charitable contributions. Generally, itemizing makes sense when your itemized deductions exceed the standard deduction amount for your filing status. For many homeowners, mortgage interest alone can make itemizing worthwhile. Second, the mortgage must be for your primary residence or a qualified second home. Your primary residence is where you live most of the time, while a qualified second home is one you use personally for a significant part of the year. A qualified second home is one you use personally for more than 14 days per year or more than 10% of the number of days you rent it out. This ensures that the property is primarily for personal use rather than investment. Finally, there are limits on the amount of mortgage debt you can deduct interest on. These limits are in place to prevent excessive deductions and ensure fairness in the tax system. For mortgages taken out after December 15, 2017, you can generally deduct interest on up to $750,000 of debt, or $375,000 if married filing separately. This limit applies to the combined amount of loans used to buy, build, or improve your primary and second home. Understanding these criteria is crucial for determining your eligibility. Missing any of these key points could mean losing out on a valuable tax benefit. In the next section, we'll explore recent changes in tax laws that may affect your ability to claim this valuable deduction. Stay tuned to ensure you're up to date with the latest information and can maximize your tax savings. Section 5 New Rules. Navigating recent tax law changes. Tax laws are constantly evolving, and it's essential to stay informed about any changes that may affect your deductions. These changes can have a significant impact on your financial planning and overall tax liability. The Tax Cuts and Jobs Act of 2017 implemented some significant changes to the mortgage interest tax deduction. This act was one of the most comprehensive tax reforms in recent history, affecting both individuals and businesses. One notable change is the reduction in the limit on deductible mortgage debt. This change was aimed at simplifying the tax code but has had mixed reactions from homeowners. As mentioned earlier, this limit was lowered from $1 million to $750,000 for mortgages taken out after December 15, 2017. This reduction means that new homeowners need to be more strategic in their financial planning. This means homeowners with larger mortgages may not be able to deduct all of their interest payments. It's crucial to understand how this change affects your specific mortgage situation. Another significant change is the elimination of the deduction for interest on home equity loans, or HELOCs, unless the loan proceeds are used for home improvements. This change has made it more challenging for homeowners to use their home equity for other financial needs. This change may impact homeowners who rely on HELOCs for other purposes, such as consolidating debt or paying for education expenses. It's important to explore alternative financing options if you are affected by this change. Staying informed about these recent changes is crucial for maximizing your tax savings. Regularly reviewing tax updates and consulting with professionals can help you navigate these complexities. Consult with a qualified tax professional to determine how these changes may affect your individual situation. They can provide personalized advice and strategies to help you make the most of your tax deductions and credits. Section 6 Case Study: The Smiths/their Tax Bill. Let's meet the Smiths, a hypothetical family who successfully utilized the mortgage interest tax deduction to save a significant amount on their taxes. John and Jane Smith purchased their first home in 2024 for $500,000 with a 30-year fixed-rate mortgage at an interest rate of 5%. In their first year of homeownership, the Smiths paid over $20,000 in mortgage interest. By itemizing their deductions and claiming the mortgage interest deduction, they were able to reduce their taxable income by $20,000. This resulted in a significant tax savings for the family. The Smiths used their tax savings to bolster their emergency fund and contribute more to their retirement accounts. Their story highlights the real-world impact the mortgage interest tax deduction can have on homeowners' financial well-being. Section 7, Bottom Line: Your Home, Your Tax Advantage. The mortgage interest tax deduction is a powerful tool for homeowners looking to save money on their taxes. By understanding the eligibility criteria, recent tax law changes, and potential benefits, you can maximize this valuable deduction and keep more of your hard-earned money. Remember, owning a home comes with both responsibilities and rewards. The mortgage interest tax deduction is one of the most significant financial benefits of home ownership. Don't miss out on this opportunity to reduce your tax burden and achieve your financial goals. Section 8, Share Your Story. Join the conversation. Have you experienced the benefits of the mortgage interest tax deduction? Share your story and inspire others to take advantage of this valuable tax break. Remember, knowledge is power when it comes to your finances. Continue to educate yourself about maximizing your tax benefits as a homeowner. Seek guidance from qualified professionals to ensure you are making informed decisions that align with your financial